In this video, we'll do our valuations. So we have all of our assumptions here. I summarize them here. Our dividend 0, earnings per share 0, long-term growth, inflation, short-term growth, and H. So the first thing we'll do is the dividend discount model, which says the value of a stock equals dividend 0 times 1 plus our long-term growth divided by our KE minus long-term growth. So for Walmart, that will equal $1.96 times 1 plus 0.05 divided by our discount rate. I've forgotten what our discount rate is. It's been a while. 6.3%. 0.063 minus 0.05. That will get our valuation. I don't think we're going to like this valuation, but we'll try it. It's going to probably give us a little bit higher value than we were expecting, but it's all right. So plus 1.96 times 1 plus 0.05 divided by 0.063 minus 0.05 gives us 158.31. 158.31. Okay, the next one is the capitalized earnings model. It says the value equals EPS 0 times 1 plus your inflation assumption divided by KE minus inflation. So in our case, that will be 5.05 times 1 plus 0.025 divided by 0.063 minus 0.025. Again, it's probably going to give us a pretty high number. It's much higher than the examples I do in class often. But that's okay. If you agree with the assumptions, everything's fine. So 5.05 times 1 plus 0.025 divided by 0.063 minus 0.025. The value you get is $1.3622. I mean $136.22. And then the H model, it says that value equals dividend 0 times 1 plus long-term growth plus dividend 0 times H times short-term growth minus long-term growth, all of that divided by KE minus long-term growth. So in this case, it's a little more involved formula, but it's not too bad. The dividend's $1.96, so $1.96 times 1 plus 0.05 plus $1.96 times 3 times 0.08 minus 0.05. All of that divided by 0.063 minus 0.05. So obviously this will give us a higher number than the $1.58. So 1.96 times 1 plus 0.05 plus 1.96 times 3 times 0.08 minus 0.05. All of that divided by 0.063 minus 0.05. And we get $1.7188. If you compare that to what we got on the capitalized earnings model, the difference is $13.57. So what should that difference be? Well, if you take out everything in the first part of that formula and you just do the dividend times the H times short-term growth minus long-term growth divided by KE minus growth, that should be that difference. So you can actually check the answer. So we get $171.88, 171.88. So You could look at the average of those three, just look at the range. Maybe one's your base case, the one in the middle, your worst case is the one at the end. But you compare that to the current price of Walmart, which obviously is much lower than that right now. So we look at Walmart, they're currently trading for $80.65. Then you put a recommendation in, a strong buy on Walmart, trading well below all three valuation models. Now, one reason I'm getting a much larger number for Walmart is because of that 3.5% risk-free rate plus 3.5% market risk premium. Remember in class, I was using 3.5% risk-free rate plus 4.5% market risk premium. And when you use a 4.5% market risk premium, you generally get something much closer to what's going on in the stock market. Not that you should rig your answer to get that, but that is something to take in consideration. So I'm using assumptions I don't normally use in practice, but that's fine. You need to use your own assumptions, whatever you feel comfortable with, what you believe. Don't worry if your values come in radically different. So I kind of rigged this one so that my Walmart would come in a lot higher than the current price, just to show you that that's perfectly fine. I've seen much wider variances than what I just showed you here. But the key is that you understand what you're doing, it's logical, it makes sense. You may not have the greatest valuation model in your first attempt at doing this, but that's not the issue. The issue is understanding the process and the techniques, come up with your own assumptions, and then going with it. And over time, you'll get better, especially with the most difficult part, which is coming up with the growth rates and making sure you're comfortable with that. So hope that helps in preparing your paper.